and practical tactics to help you succeed. My name is Sheila Vertino, and today's program will be an overview of the FDIC's Structured Transactions Program. Our presenter is Thomas Galley. Tom is a shareholder in the national real estate practice of Greenberg Traurig and has extensive knowledge on FDIC's various asset distribution programs. Our moderator for this session is Al Beaudette. Al is founder and CEO of Attentis Advisors, a real estate management and consulting firm that focuses on scenario planning for real estate owners and investors. Al served as NAIOP's 2008 chairman. Before we begin, I'd like to tell you a bit about the structure for today's program. Tom Galley will give an overview of the FDIC Structured Transactions Program, and then following Tom's presentation, moderator Al Beaudette will pose questions that a typical investor might ask about this FDIC initiative. This is an audio-only presentation, and there will be no PowerPoint slides. Thank you. Gentlemen, welcome, and thanks for being with us today.
Thanks, Sheila.
Sheila and Al, thank you very much for the opportunity to speak with NAIOP's membership about the FDIC's Structured Transactions Program. I will start by providing a few statistics as a backdrop to the discussion regarding the Structured Transactions Program so that those in the audience may have an understanding of the pending volume of transactions in the program and perhaps crystal balling the prospective volume in the near and moderate term future. In the fourth quarter of this year, we will expect to see closings by the FDIC on loan portfolio transactions in and out of the Structured Transactions Program, which exceed $10 billion in volume. That $10 billion is largely focused on 5 transactions, many of which we will cover in this presentation in short order. In 2008, the FDIC took over 25 banks. Year-to-date 2009, the FDIC took over another 93 banks. Among those 93 banks were approximately $50 billion in assets. About a month ago, the FDIC announced that 416 banks failed the FDIC's grading system for asset quality, liquidity, and earnings. That announcement came in the second quarter. During the second quarter of 2009, the FDIC issued 151 regulatory orders. Nearly half of those orders were cease and desist orders. Cease and desist orders are often preceded by a bank's closure. Bank analysts are forecasting that the FDIC will take over on the order of approximately 200 banks during the next couple of years. Going to the Structured Transactions Program, I'd like to provide a little historical volume, talk a little bit about pending transactional volume, and then describe how the program works. To date, the FDIC has completed 6 transactions in the Structured Transactions Program. The loan portfolio sizes in which the FDIC sold interest in the program were $145 million in one instance, and the balance of 5 transactions ranged from principal loan amounts, balances in the portfolios of $600 million to $1.6 billion. Pending transactions. The FDIC recently closed out bidding on a $1.4 billion residential loan portfolio, the loans from which were sole sourced out of Franklin Bank. The financial advisor on that portfolio was RBS Capital out of Greenwich. Bids were accepted and closed out on 8/31. We understand an award was made. We do not know yet who accepted that award or was made the award, but transactional closing is to occur soon. Many in the private equity world and institutional investor world didn't focus much on the RBS Capital portfolio of residential loans because they were loans on single-family units, townhomes, single-family homes, condos. However, viewing that transaction from the perspective of the structure of bids offered in that portfolio for the first time was critically important to seeing where the FDIC is going relative to how it structures or permits bids to be structured for the acquisition of interest in these distressed portfolios. I'll speak a little bit later about the unique structure that was offered for the first time in this program in that RBS portfolio, but it was very similar to the structure for bids contemplated in the legacy loan program that was shelved a few months ago by the FDIC. Pending transactions. There are 3 pending transactions for the sale of interest in large distressed loan portfolios by the FDIC and the Structured Transactions Program. The first is a portfolio of $3 billion of acquisition, development, and construction loans for residential properties. In this instance, these are not single-family homes, townhomes, or condos, but development projects. They are multifamily projects, condo projects, single-family projects, townhomes, and other PUDs. The assets that are securing loans in this portfolio range from partially constructed projects to raw land which is entitled, unentitled, and everything in between. In a few instances, you'll see completed product that simply lost its takeout financing. The $3 billion pool, as is in the case with the next 2 portfolios that I'll describe, will be marketed as one portfolio and also marketed in separate pools, permitting bidders to bid on any one or combination of pools in the entire portfolio. The announcement relative to the method of pooling that was adopted by the FDIC and their advisor KBW on this portfolio will be announced any day now, as will an announcement come on any day with respect to the other 2 portfolios we'll describe. The $3 billion of loans in the KBW portfolio are largely concentrated in Georgia. The concentrations are Georgia 31%, Arizona 12%, Texas 11%, Nevada 10%, Florida 6%, and California 4%. Only 14% of the loans are performing. An initial announcement for this portfolio came out on 8/20. We're expecting a secondary announcement any day. Due diligence on this portfolio will start 9/21, and bids are expected to be due on 9/12. These dates I'm providing you are all preliminary announcements, preliminary information. They may be modified any day or perhaps during the course of due diligence, as often occurs with an extension of bid due dates. Which means in the instance of this $3 billion portfolio, the prospective bidders will only have approximately 6 weeks to perform due diligence, a relatively modest time frame for such a volume. The next portfolio I'll describe is a $1 billion portfolio of acquisition, development, and construction loans for commercial properties. The advisors on this portfolio for the FDIC are Pentalpha Capital and Midland Bank. Pentalpha Capital out of Greenwich, Connecticut, Midland Bank out of Kansas City, which is a PNC subsidiary. Again, in this portfolio, the collateral is largely real estate, much land, partially constructed projects, partial vertical, no vertical, and just pure land, some entitled, some unentitled. Some completed product that simply, again, lost its takeout financing after construction. The loans are located in 23 states in this portfolio. The loans, I should also mention, for all 3 of these portfolios I'm describing as pending transactions, are an aggregation of loans from 23 banks that the FDIC took over. Some of those banks were taken over by the FDIC in 2008. Unlike the first 6 deals and unlike the RBS Capital deal, all of which were sole sourced from one bank, these portfolios are an aggregation of loans from 23 banks. In some instances, there'll be less than 23. At most, there'll be 23 banks. So it took a little bit more time relative to the due diligence effort by those providing services to the FDIC to compile the due diligence files and create some semblance of uniformity in the presentation of due diligence materials for the 3 portfolios. As I mentioned, the loans are located in 23 states, and this bank, this portfolio of $1 billion is being marketed by Pentalpha and Midland Bank. The highest concentration, again, is in Georgia at 36%, Nevada at 22%, Texas 7%, Arizona 7%. That makes up about 70% of the portfolio. No other state has more than 5% of the portfolio. The average loan balance for loans in this portfolio is relatively modest. We are, again, expecting an announcement relative to the method of pooling for the entire portfolio, offering an opportunity, if these poolings occur on a geographic basis, which is often the case, for regional investors to have an opportunity to acquire assets in their general locale. A preliminary announcement for this portfolio went out by Pentalpha on August 24th. We're expecting another announcement to describe the pooling. Due diligence is expected to start on 9/21, and bids are expected to be due on 11/21. With closing to award, we expect in all 3 circumstances to be made approximately 1 week after bids are closed out, and then closing typically occurs 2, 3 to 4 weeks after the bid is awarded. The deposit for all three of these portfolios is at $250,000. In the event an investor places a deposit of $250,000 for any one of these portfolios, it will also serve as a deposit for every other of these three portfolios, so that investors are not required to put down a $250,000 deposit for each portfolio. The last of the three portfolios I described is a $1 billion portfolio of commercial real estate loans, primarily some multifamily loans on real estate that is completed. There are a few loans that are backstopped by land, but that's a substantial majority in the portfolio. Some FF&E loans as well. 50% of the loans in this portfolio are in an average balance of $1 million to $5 million. 55% of the loans in this portfolio are non-performing. The highest concentration of loans as a percentage of principal balance, again, in Georgia at 26%, California at 19%, Nevada at 15%, Florida at 14%, and the balance are in 24 other states. This portfolio also is likely to be carved up into pools, and we are again expecting an announcement relative to the methodology for the pooling, which we are expecting to be geographically focused on geographic dispersion, geographic concentration, as opposed to product type or collateral type. Again, a $250,000 deposit required on this portfolio. So I've provided a little bit of historical background relative to volume. I've provided some information about pending volume. I'll now go to describe how the program works. Usually, these transactions are announced and marketed. They're always marketed exclusively through the financial advisor selected by the FDIC to market the portfolio. They're not announced by the FDIC, although the FDIC is considering announcements on its website to direct you to the financial advisor. The process for qualification, the process for engagement in the auction process, the performance of due diligence is a changing process in every one of the programs, including the structured transactions program. The financial advisors to the FDIC on this program include KBW, which has the $3 billion portfolio I described earlier. KBW has done two other transactions for the FDIC in the past. Stifel Nichols out of New York, Nautilus Capital, Glass Ratner Capital, Deutsche Bank, Midland Bank, Pentalpha Capital, and at least two additional financial advisors were added to the FDIC's bench for this program, which are HFF and Eastil. The FDIC, in its capacity as receiver, will aggregate loans from a bunch of banks, sometimes sole sourcing them from one bank if that bank has substantial enough assets to warrant a separate transaction. And it will create a new limited liability company and contribute that portfolio of loans it is aggregated for a particular transaction to the LLC. In exchange for contributing those loans to the LLC, the FDIC will enter into a cash participation agreement with the LLC, pursuant to which the FDIC will reserve a percentage cash flow from the loan portfolio from the LLC to which is contributed the loans in exchange for the contribution. The FDIC at the outset is the sole member in the LLC. The FDIC then, when it auctions the interest in that particular portfolio for which it's created the LLC and contributed the portfolio to the LLC, will auction to the public 100% interest in the LLC. So a bidder is buying 100% interest in the LLC. However, the LLC is subject to honoring its obligations of the cash participation agreement, and the cash to which the FDIC is entitled will vary from transaction to transaction. Typically, we've seen these transactions at called 80-20 deals. That means the private party is bidding for a 20% interest in the cash flow generated by the loan portfolio, and the FDIC is retaining an 80% interest. After the realization of a specified threshold for a particular transaction, threshold is an amount after which the LLC, the FDIC's interest in cash generated from the loan portfolio is reduced, and the private party, sole member of the LLC interest, its interest is correspondingly increased, call it a promote. The threshold is established from transaction to transaction. It's all a function, certainly, of size of the portfolio of loans and relative health of the portfolio. Typically, a private party will buy a 20% interest in the cash flow in these transactions, We have seen transactions starting at 20% for the private party with a promote to 40% interest after the FDIC realizes its threshold of return. That threshold is a stated dollar amount, after which the FDIC's receipt of cash reflecting that threshold, the percentage interest change. We've seen, again, private parties start at 20%, get a promote to 40% at a certain threshold. We've seen a structure where private parties started at 20% interest, got a promote to a 40% interest, and thereafter a 60% interest. We've seen one where the initial interest started at 40% with a promote to 60%. So these are established transaction to transaction. This structure permits the FDIC to realize a higher level of recovery by accepting a return on distressed assets over time, as opposed to engaging in a fire sale for its assets in the current climate. The holder, the single member of the LLC, is responsible for asset management as the sole member of the LLC, certainly the managing member of the LLC, and it's tasked with asset management for the entire portfolio. Under documents for these transactions, the LLC is entitled to a management fee of usually around 1% of the cash flow generated from the portfolio. Additional cash is used to pay expenses incurred in asset management of the portfolio, as well as litigation costs. The management fee of 1% payable to the LLC is used also to cover the servicer fee. In teaming up and submitting bids for these portfolios, private sector has to team up with a servicer and a document custodian. The FDIC is looking for servicers that are either rated among the top 3 ratings by all 3 rating agencies or otherwise approved by the FDIC. The servicers can be affiliates. The FDIC is requiring you to enter into a document custodian arrangement so that documents for the entire loan pool are in one electronic site that can be accessed by the FDIC in the event something happens to go wrong in the relationship. So cash flow from the loan portfolio is used to pay the 1% management fee to the LLC with one member of the private party. It's used to pay expenses incurred in asset managing the portfolio. Expenses are reasonable costs, reasonable categories. It's not carte blanche, and the pre-approved expenses are outlined in the documents for these transactions. Cash is also used to fund litigation incurred in connection with dealing with loans within the portfolio. In addition to using cash to pay for these expenses, the LLC can also use cash to establish reserves for ongoing operating costs, as well as a reserve for litigation costs. Among critically important qualifications for any private party submitting bid is the ability to prove to the FDIC that you have the asset management capability and historical experience among team members, whether they be as principals of the private sector funding sources or in third-party arrangements with other service providers, and that you have the cash to pay for your bid if receiving a reward, and also cash liquidity available to fund shortfalls in operating costs and litigation costs incurred in the course of asset managing the portfolio to the extent that they're not covered by cash flow from the portfolio. In instances where portfolios include loans with forward commitments, for instance, to fund, for instance, construction loans, you also have to prove to the FDIC that you, as a private sector bidder, can come to the table with your proportionate share. If we're talking about an 80-20 deal, in this case, it would be a 20% funding of forward commitments for construction draws and construction loans, as well as the financial viability to fund anything that may fall short relative to shortfall in cash flow required in order to preserve the value of a loan portfolio. Other bidder qualifications vary from portfolio to portfolio. As you can imagine, the qualifications required for a private sector bidder for 20% or 40% interest in portfolio of single-family home loans is quite different from asset management capability and other qualifications required on a portfolio of acquisition, development, construction loans on commercial properties. Those qualifications are identified in bid packages that are provided along with detailed term sheets, as well as access to due diligence databases after prospective bidders go through a pre-qualification process and submit their deposit amounts to the financial advisor running the auction process. There's much more to talk about in the qualification process, but beyond is certainly the limited time we have on this call. I'll talk a little bit about the bidding process now. During the course of bid and performance of due diligence on these portfolios, bidders can pose questions to the FDIC through the asset managers. If answers aren't readily available from the asset managers as a result of historical experience or their address of matters particular to the portfolio, they'll request that you submit your question in writing, and your question will be posted on an intranet site available to all bidders who have also put down their deposit, along with an answer from the FDIC team. Typically, questions are posed to an FDIC team comprised of both lawyers and business people, and a few answers will come back. Often, answers are collected from various FDIC officials, and one response comes back for a question. There is a prohibition on bidders from contacting any borrowers with loans in the portfolio during the course of due diligence prior to closing. In the event a prospective bidder does contact a borrower to talk about a particular loan in a portfolio, and it is found out, that bidder will be disqualified. We've heard a few tactical ploys by other bidders accusing other competitors of contacting bidders in an effort to get them bounced from the process. As I mentioned before, the winning bidder is awarded usually a week after bids are closed. They are conveyed 100% interest in the LLC. They are certainly the sole member of the managing member, and they're largely driving the ship relative to handling asset management issues relative to the portfolio. That includes discounted payoffs, it includes restructures, it includes exercise of lender remedies, it includes bankruptcy filings by borrowers, litigation generated by the portfolio, and everything else you can imagine. We should expect that there will be restrictions imposed on these transactions, certainly on bulk sales, as we are expecting that some private equity players out there may want to engage in a transaction to buy an entire portfolio and try to engage in a bulk sale of either assets secured by a particular product type or assets or loans secured by product located in a specific geographic area. Expect that those transactions be barred. That doesn't mean you couldn't approach the FDIC to negotiate a transaction, their approval for a particular bulk sale or other kind of transaction that is other than one-offs with borrowers. Bidders are expected to post a guarantee with the FDIC from a financially viable entity other than likely the SPE through which it's submitting a bid. The guarantee should be considered along the lines of a bad boy guarantee. A little bit more than that. The guarantee is guaranteed by a financially viable entity in which the FDIC has confidence relative to ability to perform on a guarantee in the event the FDIC calls on it, for the purpose of guaranteeing the performance of the obligations of the LLC under the cash participation agreement. So the FDIC obviously is concerned that an SPA is formed and obligations are not satisfied in the cash participation agreement. It wants another entity standing behind. It's certainly not a guarantee on the performance of the loan portfolio. The FDIC reserves a cleanup call option in the course of any portfolio, and it reserves the right to call for a sale of the balance of the portfolio on the earlier of the 7th anniversary after closing on the portfolio interest sale, or at a point where the aggregate unpaid principal balance of loans remaining in the portfolio are at or less than 10% of the balance of the loans that existed at closing. And I'd like to get to the unique bid structure that was offered for the first time in the RBS capital portfolio. About a month or two, the FDIC, about 3 months ago, the FDIC shelved the legacy loan program, but announced that it was continuing to analyze it for the prospect of assisting banks to do portfolio sales of their assets in order to clean up their balance sheets through an FDIC-sponsored auction process, very similar to the structured transactions program. And about a month ago, 2 months ago, the FDIC announced that it was continuing to develop the LLC program and that it would soon test the funding mechanism contemplated by the legacy loan program. Well, we saw that test in the RBS portfolio. In the RBS portfolio, the FDIC offered 3 different bid structures. It offered a bid structure of the opportunity to buy a 20% interest in that portfolio. And it also offered a bid structure which was that contemplated by the legacy loan program. It offered prospective bidders to buy a 50% interest in the portfolio. So it was a 50-50 deal. In this case, no promote. unlike the 2080 deal where your interest was typically promoted from a 20% interest to a 40% interest after the FDIC realized a certain threshold of return on its imputed equity. In this instance, it's a 50-50 deal. In a legacy loan program, the Treasury would have been your partner in the deal, in the portfolio. Here, it would be the FDIC retaining a 50% interest. And in the event a bidder selected the 50-50 structure, it would have to select leverage of either 6-to-1 leverage or 4-to-1 leverage for acquisition financing provided by the FDIC. So the FDIC for the first time was providing acquisition financing to prospective bidders on interest in these loan portfolios. In the event a bidder selected a 50-50 structure with 6-to-1 leverage, the FDIC would impose covenants, financial covenants on the portfolio, which, if not satisfied, would result in the requirement that all cash generated from the loan portfolio to the extent in excess of the management fee payable to the LLC, in excess of cash required to pay operating expenses and asset management expenses, and to the extent in excess of litigation costs, required the balance of cash be used to pay down the acquisition financing provided by the FDIC until that loan was paid down to zero, and thereafter they would permit the continued distribution of excess cash 50-50. If a bidder selected a 50-50 structure with 4-to-1 leverage, those financial covenants were not imposed on the acquisition financing. The FDIC would provide that acquisition financing. It would backstop the financing with a guarantee and reserve the right to sell the loan. This is the first portfolio we've seen. There are people who don't expect, many don't expect that loan to be sold. But if it were sold in the open market, it would be at a relatively modest interest rate because it's backed by the FDIC with a guarantee. And the FDIC would realize a fee for that guarantee. What was also interesting in the RBS portfolio is that the FDIC afforded bidders the opportunity to bid different structures on the same pool, any combination of pools, or for the entire portfolio. So if the RBS capital, for instance, had 5 separate pools in its $1.4 billion balance of loans, one could bid on individually on any one of the 5 pools, any combination of the 5 pools on an 80-20 structure, a 50-50 structure with 6-to-1 leverage, or a 50-50 structure with 4-to-1 leverage. There are lots of people out there that would love to be flies on the wall relative to watching how the FDIC and its financial advisors went about selecting and awarding bidders with varying bid structures proposed for separate pools and combinations of pools. That concludes my presentation. With that, I'd like to turn it over to Al, and I'm going to take a breath.
Well, thank you, Tom. Not only was your presentation enlightening, but it also generates a ton of questions. But in respect for everyone's time, I'm going to narrow the questions considerably and focus on just a couple. The first question, Tom, would be, there are a number of folks on this call that are smaller investors and developers and service providers, and unlike the RTC days, the deals that the FDIC is doing now sound huge. And how does a smaller player in a given market participate in these kinds of opportunities? What would be your advice to them?
Well, there are a couple of real opportunities for mid-sized private equity funds and regional investors in this program. And there are many other opportunities available in others of the FDIC's asset disposition programs that are certainly not the topic of this presentation. However, on the structured transactions program, let's use the example of a $1 billion portfolio that's being offered at an 80-20 structure. The $1 billion portfolio certainly is going to be selling for par, face value, or anything close to it. What we have seen in the first 5 transactions out there, we have seen pricing on the 20% range from about 9 cents on the dollar to about 39 cents on the dollar, and it certainly it has to is largely a function of whether there are construction loans, land loans in the portfolio as to whether you're on the lower end of that pricing or the upper end of that pricing. So when you get down to, say, 30 cents on the dollar on a $1 billion portfolio, take a multiple of only 20% of that, all of a sudden the $1 billion portfolio becomes affordable to even mid-sized private equity funds. When you consider that that $1 billion portfolio will be sliced up into pools and likely be geographically concentrated, let's use Georgia for an example, in the 3 portfolios that are about to be launched on the market on 9/21, each one of them have approximately 1/3 of their assets concentrated in Georgia, and we're expecting a pool to be all Georgia and perhaps even 2. But if 1 pool or 2 pools were in Georgia and there were 5 pools among the 1 billion, all of a sudden when you apply the multiples, if we could separate, say the 1 billion had 5 pools at 200 million each, and you were buying a 20% interest in a $200 million pool, and then consider that you're only bidding 30 cents on the dollar, and then layer on that the prospect of acquisition financing, although we don't think acquisition financing will be available in any one of these 3. It hasn't been announced, isn't certain. All of a sudden the dollar amounts get into the single-digit $1 million as opposed to the $1 billion number for the entire portfolio. So therein lies, I think, very good opportunities for smaller private equity firms, smaller investors, and certainly regional investors for acquisition of distressed loan portfolios from the FDIC through the Structured Transactions Program. With respect to service providers, there's a spectrum of opportunity for everyone in the industry. The difficulty, of course, is identifying who prospective bidders would be for portfolios or pools within portfolios, exploring prospects for engagement by those prospective bidders to assist on their due diligence efforts. The most significant assistance that any of the prospective bidders will require are valuation services. And valuation services themselves will be relatively dispersed relative to what kind of product is in the portfolio. The valuation agent for a construction project, development project, would be probably very different from a valuation for raw land, which would be probably different from the person with expertise for valuation of completed product. And then the aspiration, I think, of most of us providing services to prospective bidders is that we are providing services to the bidder who is awarded the contract, in which case we have the opportunity to represent that awarded bidder on a number of fronts relative to asset management of $1 billion, $2 or $3 billion pool post-closing. That requires brokers, it requires property managers, it requires construction companies, it requires lawyers, and everyone else in the service industry. So obviously all of us are seeking to represent that bidder, but we'll never know who the successful bidder is, or likely be able to forecast who that bidder is, as their views of value and pricing, certainly in the uncertainty of these large distressed portfolios, will vary significantly.
Well, Tom, let's go to the other end of the spectrum for a second. You mentioned the FDIC has closed 93 banks so far this year, and most are small and not well known. But last Friday they closed down Chorus Bank, the largest lender of high-rise residential in the country, and some of those projects are still under construction. But so how does the FDIC swallow this one, and what's kind of the roadmap on a deal like that, and what happens to all those projects that are currently under construction?
That's a great question. I can talk about a few things that we're hearing generally among the network of people that are sort of closely following what's happening with Chorus. Chorus is the elephant in the room relative to, or one of the elephants in the room relative to what the FDIC is needing to address in the current climate. There were a number of teams pursuing the prospect of acquiring Chorus as a bank. Many of those teams were private equity firms, which were publicly announced. There's no news to anybody. There were a number of private equity teams announced that were pursuing the opportunity to buy Chorus as a going bank. And what they were, I think, really after is the troubled asset portfolio that Chorus Bank had under ownership, as opposed to buying the franchise or its deposits. The FDIC, it appears, was not able to come to agreement with any of those private equity teams relative to the sale of the entire bank with all its assets. And we saw, last Friday, an announcement that the Chorus Bank was taken over and flipped out to MB by the FDIC. It flipped the bank as a franchise and its deposits. It did not sell to MB the substantial majority of the loan portfolio that was owned by Chorus. The game plan, we understand, with respect to that portfolio will be a negotiated private sale. We are hearing in the marketplace that the structure for that transaction will be similar to the structure in the structured transactions program, although don't have that confirmed by any FDIC source, and we don't suspect if we requested the confirmation that they'd be at liberty to say, because just like the highly confidential negotiations for the sale of a bank, this transaction also for the sale of Chorus assets, its loan portfolio, is highly confidential. All of those in the mix, as reported in the press, are subject to very stringent confidentiality requirements, so that they won't be talking even if requested. But what we're expecting is a sale to one of those private equity teams. We're expecting the transaction to look very similar to what I described as the typical structure in the structured transactions program. We don't know whether they expect an 80-20 deal, 40-60 deal, or something else, but we do expect the FDIC to retain an ownership. We are expecting that the award will be made in about 3 weeks to a month, is what we're hearing in the marketplace, and closing on these kinds of transactions, the structured transactions program, and in this transaction for Chorus assets, will likely occur 3 or 4 weeks after the award is made. It is unusual, I think, for the FDIC to engage in a private negotiated transaction for a large portfolio of loans, but I think Chorus will be a big exception to many rules, as the Chorus portfolio is unique. It, as you mentioned, Al, is reputed to have a significant number of construction loans on condominium towers, and the FDIC I don't think can afford the delay between the date it took over Chorus and the date it would otherwise likely bring such a portfolio to market, which delay could be, easily 4 months, more likely 6+ months. We don't think it can afford that delay, because if it stops funding on those construction loans, there would be a substantial deterioration in the value of the product for which funding is required. And I think that is probably the biggest reason that the FDIC continues in a private negotiated sale with large private equity teams for that major portfolio. It's really a preservation of value. They must have concluded that the deterioration in value that otherwise would result had they opened bidding to the auction process as contemplated by the structured transactions program would outweigh the increase in bid, the prospect of an increased bid they would get from a public auction process.
Well, thank you, Tom. I know there's a ton of other questions that I'd like to ask you, and I'm sure a number of folks on the call have questions that they would like to ask, but unfortunately we are out of time. So I'm going to turn the program back over to Sandy and Sheila. And Tom, thank you again for a very enlightening presentation.
Thank you very much to Sheila for the opportunity.
Well, thanks, gentlemen. That really was some remarkable insights into obviously a very valuable project that's coming up with the FDIC and those pending large loan portfolio transactions. For those of you who would like to hear the presentation again, there was a lot of information in there. We realize that. It will be available by close of business today, and we'll post it along with all the other Solution Series programs on the NAIOP corporate website. That's at www.naiop.org. You just click on the large button on the front page, and it says Solution Series. That will take you right to it. For the next Solution Series program, be sure to watch your email from corporate. The program is going to air on September 30th, and we'll be sending you an email with details about the topic and the presenter. We also have full-scale webinars in addition to these Solution Series programs. These are the online briefings are 90-minute webinars for topics that require more in-depth educational experience, which you might recommend that this topic be considered for a future webinar. The next full webinar would take place, as you can see, on Thursday, October 29th, and with Scott Kreiner. He's going to talk about the use of metal roofs and walls and reducing energy consumption in buildings. In response to your requests, the cost of webinars has been dropped, and it's now $65 for NAIOP members and $95 for non-members. If you would like to register for this upcoming full webinar, you just go online to naiop.org I want to thank you again for attending our session today. Please let us know what topics and presenters you'd like to hear from in future programs. We encourage you to be part of the solution. Goodbye for now.